Home Depot just reported their third consecutive quarterly earnings miss, slashing their 2025 profit forecast by 150%. And this retail giant's collapse is sending shockwaves through the entire housing market. Here's the brutal reality. America's home turnover rate just hit a 40-year low at 2.8%, and Home Depot's empty aisles are becoming the economic equivalent of a canary dying in a coal mine. But here's what Wall Street analysts and mainstream media aren't telling you about this economic warning signal. Look, we've been tracking housing market data for years, and we've never seen numbers quite like what we're witnessing in December 2025. Home Depot's third quarter earnings came in at $3.74 per share, missing analyst expectations of $3.84. But that's just the tip of the iceberg. The real story starts with what Home Depot's CFO Richard McPhail told investors during their November earnings call. Our customers are homeowners. They are seeing home prices now decline in more markets than rising. And we know they have job concerns. This all comes together in the form of hesitation to take on larger financial commitments. Let me break down exactly what this means for anyone looking to buy, sell, or invest in real estate right now. First, let's examine the hard data that should terrify anyone involved in the housing market. Home Depot now expects their full-year adjusted earnings per share to decline approximately 5% from fiscal 2024's $15.24, compared with their previous forecast of just a 2% decline. That's a 150% worse outlook than what they predicted just 3 months ago. But here's the pattern that reveals the true depth of this crisis. Customer transactions declined 1.6% year over year, though average ticket prices increased 1.8% as consumers across income levels avoided large-scale projects. This tells us that fewer people are shopping, but when they do shop, they're buying more expensive items. Classic signs of wealthy customers still spending while middle-class buyers retreat entirely. Comparable sales for the quarter rose only 0.2%, essentially flat growth for a company that's supposed to be benefiting from America's aging housing stock. When you're running a business built on home improvement and you can barely eke out positive growth, something fundamental has broken in the economy. And here's the detail that should keep real estate investors awake at night. Reduced storm activity in the quarter decreased demand for emergency supplies like roofing materials and generators that typically drive sales during severe weather. Even natural disasters aren't enough to boost Home Depot's sales anymore. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. To understand the severity of what we're witnessing, let's put these numbers in historical perspective. The last time U.S. existing home sales adjusted for population were this low was in the early 1980s, when the average 30-year fixed mortgage rate peaked at 18.63% in October 1981. But here's the critical difference. In the early 80s, we had sky-high inflation and astronomical interest rates, but homeowners weren't trapped by artificially low mortgage rates like today. Back then, when rates fell, people actually move and transact. Today, we have millions of homeowners essentially imprisoned by their sub-4% mortgage rates, creating an unprecedented market paralysis. Home Depot's annual net income declined 11.47% from 2023 to 24, falling from a little over $17.1 billion to $15.143 billion. From 2024 to 25, Home Depot's annual net income declined 2.23%, falling from $15.143 billion to $14.806 billion. To put that in perspective, the last time we saw consecutive years of declining profits this severe for Home Depot was during the 2008-2009 financial crisis. What makes this particularly ominous is that we're seeing these declines during what should be a period of massive home improvement demand. America's housing stock is aging rapidly, with millions of homes built in the 70s, 80s, and 90s hitting their major renovation cycles. The fact that Home Depot can't capitalize on this demographic tailwind suggests deeper structural problems in the economy. Now, here's where this story connects directly to the housing crisis that's unfolding across America. Just 28 out of every 1,000 homes in the United States changed hands between January and September 2025. Marking the lowest annual turnover rate since at least the early 90s. To put this into perspective for you, this represents only 2.8% of housing stock being sold, down from 2.9% in 2022 and 3.4% in 2019. We're talking about a 37% decline in housing activity compared to pre-pandemic levels. But here's the hidden factor driving this paralysis that most people don't understand. Over 60% of homeowners currently have a mortgage rate below 4.5%, with the average mortgage rate sitting at 4.1%. Meanwhile, current mortgage rates remain stuck between 6 and 7%, making refinancing or trading up financially devastating. Think about what this means. If you're a homeowner with a 3.2% mortgage rate who wants to upgrade to a larger home, you'd be looking at potentially doubling your monthly payment even if you bought the exact same house. According to the Federal Housing Finance Agency, 69% of outstanding mortgages had a contract rate of 5% or less as of Q1 2025, and 24% at a rate less than 3%. This creates what economists call a lock-in effect. And an FHFA report concluded that this rate lock-in effect prevented 1.72 million home sales between Q2 2022 and Q2 2024. That's 1.72 million transactions that should have happened but didn't. And each one of those represents thousands of dollars in lost Home Depot revenue. The housing freeze isn't affecting all markets equally, and this regional analysis reveals where the most severe disruptions are occurring. San Diego's 2025 turnover rate hit just 1.8%, while major markets like New York 1%, Los Angeles 1.2%, San Francisco 1.3%, and San Jose 1.5% posted even lower numbers. What's particularly troubling is that Sunbelt markets, which drove much of the pandemic-era growth, have seen turnover rates collapse, with San Antonio's turnover rate 2.4% falling furthest among the 50 most populous metros, followed by Charlotte, North Carolina, Jacksonville, Florida, Miami, and Orlando. This data tells us that even markets that were supposed to be recession-proof due to population migration are now showing severe stress. For several estate investors, this suggests that the geographic diversification strategies that worked during the pandemic may not provide protection in this new environment. Here's an angle that reveals even more about the depth of this crisis. Home Depot's professional contractor business, which was supposed to be their growth engine, is also struggling. Despite their massive $18.25 billion acquisition of SRS Distribution in 2024 to boost their professional contract services, the company is still seeing weakness across core categories. This is particularly significant because professional contractors typically have more predictable revenue streams and are less sensitive to consumer sentiment. When even the pros are pulling back on purchasing, it suggests that the construction industry itself is anticipating a significant downturn. The ripple effects extend beyond just Home Depot. Home Depot's main competitor, Lowe's, reported comparable sales growth of just 0.4%, also missing expectations, with management warning that shoppers are shying away from big-ticket projects. When both major home improvement retailers are struggling simultaneously, it confirms this isn't a company-specific problem. It's an industry-wide demand collapse. Here's what makes Home Depot such a reliable economic indicator. Around 90% of Home Depot's DIY customers are homeowners, making them particularly sensitive to housing market conditions. When these customers feel uncertain about their home's value or their job security, they stop spending on discretionary projects. McPhail explained that customers have been in a deferral mindset since mid-2023, postponing big-ticket remodeling work. This isn't just about wealthy people cutting back on luxury renovations. This is middle-class homeowners refusing to take on debt for necessary home improvements. Everyone's expecting rates are going to fall, so we're deferring those projects, Home Depot CEO Ted Decker explained during their August earnings call. But here we are in December 2025, and those rate cuts haven't materialized in any meaningful way. The ripple effects are devastating. With higher interest rates pushing turnover in the housing market towards 40-year lows, people are less interested in financing bigger renovations. No new homeowners means no nesting purchases. No home sales means no renovation projects to prepare properties for market. Here's the demographic shift that's accelerating this housing market freeze. The average first-time home buyer is now 40 years old, a record high. Let me repeat that. The average age of someone buying their first home has reached 40 years old. First-time buyers now comprise just 21% of all home purchases, a historic low and half the share of first-time buyers from a generation ago. This represents a complete collapse of the traditional homeownership pipeline. NAR estimates that a 10-year delay in home ownership could mean losing about $150,000 in equity on a typical starter home over a lifetime. We're watching an entire generation get priced out of home ownership, and that has massive implications for future housing demand. The Home Depot story doesn't exist in a vacuum. PwC reports that U.S. consumers plan to spend 5% less on seasonal purchases in 2025 compared to 2024, with 84% anticipating further cuts due to inflation and economic uncertainty. As Home Depot CFO Richard McPhail confirmed, our customers tell us that they remain on the sidelines due to uncertainty and perhaps the hesitation to make larger financial commitments amid an uncertain economic environment. This isn't a minor shift in shopping habits. This represents a full-scale retreat from financial risk. Regional data shows the crisis is nationwide. San Diego's 2025 turnover rate hit just 1.8%, while major markets like New York, 1%, Los Angeles, 1.2%, San Francisco, 1.3%, and San Jose, 1.5%, posted even lower numbers. Even traditionally hot markets are freezing up. For buy and hold real estate investors, this data suggests we're entering a period where cash flow will be king. With fewer people moving and home improvement spending collapsing, focus on properties that can generate strong rental income without requiring significant capital improvements. Fix and flip investors should be especially cautious. With Home Depot's data showing consumers are avoiding big-ticket purchases, the market for heavily renovated properties may be shrinking rapidly. Consider pivoting to light cosmetic improvements or focus on markets with stronger fundamentals. For those considering REITs or real estate stocks, Home Depot's struggles suggest the entire real estate ecosystem could face pressure. However, this may create opportunities for contrarian investors willing to bet on an eventual recovery. As we head into 2026, here are the key indicators to monitor. First, watch for any meaningful decline in mortgage rates below 6%. Second, track regional migration patterns. If the Sunbelt markets continue to weaken, it could signal a broader shift in demographic trends. Third, monitor Home Depot's quarterly results for any sign that their professional contractor segment is stabilizing. As one analyst noted, we're not watching demand die, we're watching it stack up. The critical question is whether this pent-up demand will be released gradually or all at once, creating significant market volatility. If you're a potential home buyer, this data suggests we're in the early stages of a demand destruction cycle. Yes, high mortgage rates are keeping many sellers off the market, which constrains supply. But the bigger story is that potential buyers are also retreating, which could eventually pressure prices downward in many markets. For real estate investors, Home Depot's struggles signal broader consumer weakness that could impact rental demand, renovation costs, and property values. As one analyst noted, we're not watching demand die, we're watching it stack up. The question is, when this backlog of deferred projects finally breaks loose, will it create opportunity or chaos? This institutional money seems to be betting on chaos. Home Depot's stock has underperformed the broader market significantly in 2025, and analysts are viewing the retail giant's underperformance as an early warning of a broader U.S. economic slowdown. Home Depot's empty aisles have become a canary in the nation's economic coal mine, and that canary is sending us a very clear warning signal. When America's largest home improvement retailer can't grow sales despite the oldest housing stock in history, rising home values, and massive deferred maintenance backlogs, something fundamental has broken in the economy. The housing market isn't just slowing down, it's freezing up in ways we haven't seen since the early 80s. And if you're planning to buy, sell, or invest in real estate over the next 12 to 18 months, these Home Depot numbers should be your wake-up call to prepare for significantly more volatility ahead. What do you think? Is Home Depot's collapse the early warning signal we've been waiting for? Drop a comment below with what you're seeing in your local housing market, and hit that notification bell because next week we're breaking down which specific regional markets are most vulnerable to this economic storm that's building. Remember, in times like these, information is your most valuable asset. Stay informed, stay prepared, and I'll see you in the next video.